today is Tuesday, February 9th, 2016. So welcome, everybody. We've been enjoying quite a bit market volatility. Andrew was mentioning how he's amazed how the volatility keeps staying up.
Yeah, the back and forth in the market is pretty amazing. You'll have a strong move one day and you expect follow through, and instead the market just turns right around. Which leads me to something I'd like to discuss, and that is the downside adjustments in the road trip trade. I noticed that in this market with the high volatility, once I put on a put debit spread to protect the downside, it was almost impossible to know when it was safe to take it off. And I'm wondering if in a volatile market like this, if it's better to roll the position down rather than put on debit spreads, because once you put that debit spread on, you're pushing down the upside expiration line because of the money that you paid for that spread. And if you put it on when the market's down near the lows, and then you have the bounce and you take it off, you've locked in a loss, and then you could very well be stuck having to put it back on again when the market turns around and goes down. So it seems to me that just rolling the position down is a better response, at least in a volatile market where it's not going to trend for long in one direction.
Yeah, Andrew, I would agree with you, and I think what I'm finding is I'm having to sort of bucket the different types of adjustments, and I think the ones originally presented were more for a uptrending, choppy market, and I think that's sort of the bucket I would put those types of adjustments you talked about in, and then rolling down would be sort of more of an sideways to down or a bearish higher volatility type adjustment. And then also, I don't know if you guys are following along with what Tom's been doing, which is an interesting adjustment. I don't quite remember it in the presentation, but he's taking off some shorts by adding a vertical to reduce risk and margin. So I think those are definitely, I'm in your camp, those are more aggressive, which fits more and aligns with the current environment.
Well,
rolling it down and taking off shorts, yeah.
In trying to keep with the spirit of the trade, which was as simple as possible. Mm-hmm. I think rolling the position down, it's a little more complicated in terms of execution than adding verticals. But I found with my March road trip, I had to put on a vertical when we were way down there. And I just never took it off because, I wanted to see the market, well above the upper longs for more than a day, and it just, it never stayed there. So I was glad I never took it off because a couple of times we went right back down, and I could, easily see, over adjusting where you're taking it, putting it on, taking it off, putting it on, taking it off, and locking in losses every time.
Right,
and getting to the point where you could never make money in the trade.
Right. It's sort of, and I'm sort of, it's got an M3 sort of aspect in terms of if you get underwater too far, it's going to be pretty difficult to get it back, resuscitate it. So I'm with you. You're better off in this environment rolling it down or flipping it, and or taking off shorts via, adding a vertical to the top side. But if you're in more of a bullish sort of uptrending market, those types of adjustments are overdoing it. So I think you have to identify what market you're in and then look at your tool set, your available adjustments. But I'm in total agreement with you, Andrew. That's been my observation.
Yeah, Andrew, that's a good point. I think the other thing to evaluate here is if, like you're saying, if it's getting into that lower tent on a frequent basis, you're buying debit spreads and then taking them off and then putting them back on. So you're going to be losing money net on that. So is the original premise of a 40 by 50 in all markets valid? it's almost like it's not wide enough or not far enough away where you're having to dink with it quite a bit.
That's a great point, Chuck. And my 2 cents is I've found that the T+0 line is a little more stable with the 40 by 50, flatter and stable. There's not as much gamma. But the wider ones, it's a looser gamma line, if you know what I'm saying. It's sort of in the back third, it's going to start to tilt down more. But the trade-off is you have more tent. So I think that's the way you have to look at it, right? If you want a wider tent, you're going to give up gamma line stability. But there's other ways to sort of offset that as well, right? So at entry, you might add a debit spread at entry to sort of shore up the line. And again,
there's no free lunch, but I mean, now you can get them on cheap.
Yeah.
The reason you can get them on cheap is because you're taking on more risk to the downside because you don't have as many short deltas.
Exactly. And one thing that's been kind of interesting is you can put those on for a credit initially, right? If it's a little bit wider and maybe if it's a little bit more below the money. So your upside's taken care of, but then you've got that sort of downside risk. But then you could take that credit money in a sense and help finance any verticals that you want to put in there if it does sort of get below your shorts or get into that bottom third. So that's kind of the pros and cons that I've seen for going wider.
I mean, the other thing that
my testing of this trade, I tried to back test for about 2 years and I didn't get all of it done, but every time I tried to put debit spreads, because of all the problems you just said, I never could make it work when I started doing put debit spreads. And so I told myself, if I'm going to trade this, we get to the bottom of the tent, I'm just going to exit. And so far I've exited one that way and I made about $30 on it, but I also can say so far I've got another one that's near the bottom of the tent. It's an April expiration, and it's down about 800. So, you aren't always going to make a profit if you exit the bottom of the tent. But I think just exit and go on might be the best plan, for me anyway.
Well, it will give you the flexibility of reconsidering your entry. I mean, you don't have to, you could wait a day or wait a few hours before you put the other part back on.
Yeah. Remember that this trade is also extremely similar to John Locke's M3U, the unhedged M3, right? So, and if you look at how he adjusts to the downside, he basically rolls, right? He's not adding debit spreads really to the bottom. So that's something else that goes in that favor as well.
I found that the 40-50 size hasn't really been a problem. The market's kind of been chopping around, just enough to take you down to the level where you need to do something to the downside, and then it's bounced back. My March trade, I think twice I went from the lower third to above the upper long the way the market's been moving. And if you maintain that original structure, you don't really have to worry about the upside. Your upside risk is so minimal, especially if you're putting it on cheap. I mean, I put my April trade on it at 30 cents the other day. So the upside, is not a problem, and therefore, if you roll the thing down and the market does take off to the upside, you usually have plenty of time to, put on a reverse Harvey and eliminate that upside risk if the market's going to stay up there. I think going forward, my downside adjustment of choice is going to be to roll down. Unfortunately, with the asymmetric structure, it's not quite as easy to do in one order the way it is with a symmetric butterfly. But I think it's still, worth the little extra trouble because it seems to produce much better results.
Yeah, in this environment.
Right.
In other words,
in a low volatility market, what we had probably, 2 years ago and 3 years ago, different story.
Right. You wouldn't roll it down. You'd do that's why I was saying I think the timing of the way this happened to be rolled out at nobody's fault was a different environment. And then just as soon as we all kind of got introduced to it, I think we can all agree we're in a more bearish environment. So
yeah,
interesting.
Yeah, Stephen, just to force you at that point, if you look at the statistical vol versus the implied vol, it's surpassing it for the last 10 weeks. So it has been made the short vega trading more difficult.
Yeah, and keep in mind, M3U or M3 in any of its variants, the soft spot or weakness is aggressive downside moves. So it's as we know, there are no trades that are one trade for all markets. Ron may debate that a bit, depending on how his space trip's used, which is quite frankly could be a nice little segue to.
Yeah, I remember that I mentioned in the start of the presentation that it was designed for this current market, right? Which is huge volatility and overall bearishness.
And as I was going to say, it could be a segue to some of your stuff. This could be a nice bolt-on strategy to the road trip.
Yeah, or vice versa, right?
Or vice versa, yeah.
The other thing is I'd be tempted to start a little lower down too, because the risk is all to the downside and the upside is so much easier to handle.
Right.
I'd be tempted to start, rather than, having the upper long close to the market, rather, 10 points or 15 points below the market to get that extra room.
Remember, Andrew, though,
go ahead.
Yeah. I was just going to say, if you are going to do that, and I know I sound biased here, but you may want to consider a space trip instead, right? Because a space trip is going to give you tons more downside room, and it would actually enjoy a downside move at the same time, and you're going to naturally start getting more negative deltas as time goes by as well. And I showed you a side-by-side with a standard road trip, right? And you can see that they're very equivalent type of trades, but in my opinion, there's actually, if you're expecting bearishness, I think the space trip is going to give you more of an edge than the road trip. If you're expecting neutral to slightly bullish, then perhaps the road trip, but if you're neutral to bearish, I think it's a no-brainer. I think it's a space trip.
Or a combination, like we said.
You could, but I mean, why do that to a degree, right? Because, again, if your bias is neutral to bearish, then why put on a structure that is neutral to bullish, right? I know that you might say, well, we don't know where the market's going to go, but if you have that particular bias, you can extremely easily make a small little tweak on your space strip and basically flatten out completely rather than be a little bit negative delta.
It seems like you could really cover lots of bases if you had both, which is essentially the same as layering. So I guess my response would be, I agree with you, but why not have both? What's the downside to having a road trip or an M3 and have it hedged with a space trip?
Because you're putting on...
Let me just add here is I just think that neutral is out. I mean, down is probably good and up could be good. I don't know. But it just doesn't feel like we're going to stay anywhere.
Yeah. That's a good point. So, Ron, you don't feel like that's an effective configuration?
Well, no. I don't want to put that kind of message out because, to a large degree, I developed the space trip in order to be able to do that, right? To basically have a hedge and also have it to hedge my at-the-money trades, right? The thing, though, that has been kind of weird in my own head is that every time that I'm kind of going, okay, when should I put on my next M3 or what have you, then I'm like looking at the markets and I'm still bearish.
Yeah, you make a great case. Those aren't bearish trades. Yeah.
So, and right now I've got a ton of space trips on and they're doing perfectly fine. So I'm thinking, why put on something that has the opposite bias to what I expect?
It's kind of forcing it. It feels like you're forcing it, yeah.
Yeah. When the market starts turning around and shows me some bullishness, then I'll probably start layering in some M3s at the money. But for now, I'm just sticking to the space trips.
Ron, hi. It's John here. I'm curious. I just was thinking about this the other day. I don't see a huge number of fans of the bearish butterfly, and you seem to. Well, they never seem to be discussed much. I mean, I personally am a huge advocate and trade them all the time. But you're talking just then about your bearish bias. I wonder why. Do you trade the bearish butterfly or is it?
Yeah, I do. Well, I did put it that way. Now my preference is to put on a bearish, if I have any kind of slightly bearish bias, then my preference is the space trip. And the many reasons why, but one of the big ones is that I'm trying to leverage portfolio margin power, right? Do you guys want me to show you a couple of live ones? Because I got asked this yesterday, and I know that many of you may not be trading it yet. But I
understand the theory of the space trip as a long-term bearish trade. If you're bearish, for me, there's no finer trade than the bearish butterfly. You know, I mean,
but the thing is, I think find that
I think what you'll find is that there are a lot of people like me who got burned very badly back in 2013, and they're still a little gun shy about really committing to the trade.
Right.
There's a way to hedge that, guys.
You mean the bearish butterfly, Andrew?
Yes.
Yeah.
Right. Yeah, the thing I think that kind of scares a lot of people, probably myself included a little bit, is what you do if it doesn't go in your direction, right? Because if you're expecting bearishness and suddenly you get a move up, then you're scaling in, and then you're scaling in again, and every single time you are increasing your upside risk, right? Your deltas are getting steeper and steeper in that particular direction, and I think that's kind of what freaks most people out with the bearish butterfly, right?
Your risk is increasing because not only are you putting more capital in the position, and taking on more delta risk, you're also buying more expensive butterflies as the market goes up, which increases your risk too.
Oh, sure. Yeah, I'm just on the premise of taking a view, and Ron was just sort of saying, if I'm neutral to bearish, I'd go for a space trip. Well, I would argue if you're neutral to bearish, the best bang for your buck is a bearish butterfly. If your view is purely neutral, but you want some longer term protection to the downside, then that's a different kettle of fish. Similarly, so is neutral to bullish, of course. But if you are starting out with that market opinion that you're neutral to bearish, the bearish butterfly is going to give you a better bang for your buck and a faster one as well.
Yeah, I agree. Hey, Chuck, you mentioned there's a way to hedge that. I'm curious, could you expound on that? I think you were talking about bearish butterfly.
Yeah, absolutely. A couple of challenges with the bearish butterfly, and I think a couple of adjustments to how you set them up can make a big difference. One simple thing you can do to hedge the upside is to get a call teeny in there, because there's I don't remember if it's a 70% chance or an 80% chance, but 70 to 80% of the time you'll always have a 20 point move up over time. So typically what that call will do for you is it'll hedge the upside and it'll allow you to get the full butterfly on without having to take significant drawdown. So it allows you to build it out.
Yeah, like 10 delta calls. If you do the teenies, that T plus 0 line, it's never going to help you. I think you have to be a little closer than 2 delta.
Well, that's essentially a sort of modified rock starting position, isn't it?
Yes, it is.
Well, Stephen, I went into Trade Finder, and then I've also done a lot of work in looking at skew to see what's the best thing to put up there, whether it's a call calendar or a fly or a vertical or a teeny, and everything from 28 delta to 10 delta to 4 delta, the flies and calls and so forth. But right now, with the way the horizontal skew is, if you put that call in the further out month, and you can you get a little more bang for the buck, so to speak, because of the way the volatility is set up, and it has a little less time erosion. So if you put your long call or your long call vertical out 30 additional days.
Oh, okay. So if you're 56 days on the bearish butterfly, the call will be 70 days.
Yeah, I can show you.
Or
if you
more.
want.
Yeah, no, I haven't thought about that. That's good.
I'm looking at this as just way too much, but there's. I had some.
Did you want to share that?
Sure, I can.
Go ahead.
Did you also look at other range extension techniques like rolling in the upper wing? In other words, convert it to a BWB?
Yes, but I tend not to favor that because of personally I'm trying to find something that where I'm not using any margin. So it's a strange goal, but I think one of the beautiful things about a bearish butterfly is that it doesn't use margin. So let me get this in stuff. What are those M's for in those expiration? Is that new Wednesday thing that Tom wrote about on the blog?
I think those are end of month.
Oh, those are the end of month ones. Okay. All right, so I got a lot of combos here. This is credit for Kevin Lee coming up with this, but you can do different little setups here. But if you do something like buy a call way out here, 60 days, about anywhere from 4 to 6. And then wherever you want to position I've also looked at, should the butterfly be 50 points every time and position in the same spot, or is 30 the optimal, or 40 or 50, or does it vary by so forth? But you'll get a structure that looks like this. But if you're, and you can use, and the butterfly can be positioned wherever you want. So let me put one that's a little more traditional. Yeah, here's one that's, so this is 50 points down from when I modeled it, was where this target zone is. And then I think, let's see, 60 points up. So assuming we have a 60-point range to the upside, if you're in a volatile market like this, chances are we are going to get a lot of movement. So what I've back tested is buying about $1,000 worth of butterflies and then hedging it with about $200 worth of calls. That way, if we move down, the calls go down to pretty much nothing, and you're still making money on your butterfly. But if we get a quick move up, the calls help a lot. They don't help very much if we drag up. But you have other problems you'll have to deal with, and you'll have to have delta limits and all that kind of good stuff. But I put these on in live trading. I mean, I could show you an example of something where it made a tremendous difference when I went back and back tested a trade. This was a live trade that I did last year, and as soon as I put the trade on, the market went up 46 points or 43 points like the next day. And it continued to go up 60 points from that. So if you have situations where you put it on in the market and you're dead wrong when you put it on, like if you put it on at the top of support and then just blast through that, right? So I think I'm a genius. I'm getting in here. Right. We're going to come right off of this here. We're going to trail back down. It's going to be the easiest trade ever. Well, that didn't happen. We just kept going. And this trade drew down very, very significantly. I mean, this was a half with a 5. So the 5 lot and 9. So we're drawing down significantly. This is a very uncomfortable trade. So I kind of started back and to say, hey, is there a different way to kind of deal that? Now I don't suppose to keep the call forever. Should we move up significantly, I'm going to rip it off, and that's kind of a trader's call. If you move up like 30, 40, 50 points based on the market, I pull the calls off and pocket the money and use that to pay for what I had for the roll, because I know that it's very improbable that the teeny will actually be worth anything. Right. But we know if we sell those kinds of things, we've all done condors, and you sell like 10 delta stuff, and it goes against you like crazy. So it's asymmetrical against you if you sell it. So why not play it the other way? Yeah. And then when it gets super inflated, just rip it off, or you can turn it into a butterfly.
Yeah.
And then,
Conversely, Chuck, let me ask you: if you get a downside adjustment, are you keeping the calls, rolling them down, or what do you do with the calls if you're adjusting down?
well, a couple of things. So if I don't adjust unless we move 50 points down, because it's already got bearish delta, and the way I position them is such. So I typically take them off and then reposition the whole thing. But there are occasions in back testing. Like I put a live one on like a couple of days ago, and then the market was down 50 points, and I took it off like in a day. So in that case, the calls were worth less than half than what they were, but they were still worth a little something. So I just took the whole trade off. But if this would happen late in the trade, I leave them on because they're not worth anything, right? So if this happens 19 days into the trade and we go down here, if we just take a look at the call side of this, and they're not gonna be worth hardly anything. So they're almost not worth selling. But you'd make so much on your butterfly that you've got a free upside shot of either recouping some of your money or what have you. So you kind of have to make a judgment call of do you want to go ahead and take that money off for them. And they were worth, I spent $3.50 for them in the last trade, and I took them off for like $1.20. So I lost money on them, but I made so much more on the butterflies because I had twice as many of them, and they're much wider and more expensive when you put them on. Does that help?
Yeah, that's great stuff. Thanks for sharing.
Yeah, absolutely. So the other thing I was looking at was, the butterfly position and so forth. So you can put them at the money like this, or you can do combinations of them so that you almost start into a double, if you will. And that's kind of what I'm doing now is I'm start in a double, but I'm going to have twice as many of these as I do with the calls. But I kind of like the structure of the double, and I'm also kind of pushing them out a little bit to try to.
I also noticed your width is 40 wide instead of 50.
Well, I'm going to vary that. So I built a little tool to take the data out of option view and analyze it. So I'll take the raw data out of option view here, and then I'll take a look at the skew here, and I'm looking for an optimal point to structure a butterfly. And in my view, the flatter the line here is the better bang for the buck for the butterfly. But if you get too far out, it becomes too low probability, and you're kind of stretching it. So I think there's a balance between the closer you are to the market to the further you are to the market in terms of which one is optimal. But I take a look at the 30 and the 50 and the 40 to see which ones I think are providing the best value. And then across the bottom here I have deltas because if I do strikes, they change all the time, but I know that the 50 delta is at the money. So this tells me about how far out of the money I need to be. So I just did a log here.
Yeah.
So this is centered at a 19 delta, for example. This one looks like a pretty cheap one to me, but maybe it's a little too far. But you got to remember, if it's centered at a 19, you've got a 40 points up from there. So you have a leg that's coming in that way. But I don't have. Go ahead.
I was just going to ask you. Yeah, no, that's phenomenal analysis. But if you use a 40 wide, how does that change your ad sequencing and or your adjustments? Are you still going 40, 60, 20 wide, or since you've changed a lot of things, and so it seems like that would have to you'd have to change that as well.
I did. It changes a lot of things actually. So
yeah.
if you do the butterflies out there, you have to start paying paying attention to theta problems a lot sooner in the trade. So I back tested these. Where's this? It's right here.
Good thing you're not any good at Excel. It's good stuff.
So I put together. I went back and took 3 periods where the market didn't move very much, which is this period. So the high on this period was 1266, and the low was 1208, which was only a 58-point range. And the market moved only up 2.8% and -9. And then here kind of shows you the plot. But this is where I looked at all of these different hedges and different structures. I found that at about 37 days to expiration is a good point to start worrying about the delta theta stuff if you're positioning them out. So this was the flat market. This is a market that was stressed down. This next period was from October 3rd. This is a stress down, then back up. I wanted to make sure I could deal with the chop. And then another period where we, in 2011, where we had the debt crisis thing, we were all over the place. So I wanted to make sure I could handle a stress up, a stress down first, and then a flat market with it. But to answer your question, yeah, I had to change how it's managed as well. But my goal was to try to smooth some of those drawdowns, because this was very uncomfortable. This trade here, and then you're starting to wonder, gosh, that size was way too big. And then when it finally comes in for you, it's like, oh no, it wasn't. I should have been bigger.
Yeah. Trader psychology, right?
When you use different size butterflies, do you find that one butterfly is stepping on the prices of another butterfly and making it a little confusing to follow what you have on?
Yeah, you have to be careful. You have to be careful with that, and I'm using a little bit different roll-up sequence. But I just don't feel like one size butterfly fits all in all markets. I mean, I had some 50-point butterflies on about 3 weeks ago, and vol got so high, and the market moved in my favor. But I didn't get paid for them because the vol flattened out so much that all the butterflies, 10 points up and 10 points down, were also similarly priced. Which told me that maybe my butterflies are too narrow. If the reason they swell up, I think, is because of the front part of the butterfly. This portion up here is more likely to be in the money than this stuff back here. And when there's a belief that we can just crash right through it, then the butterfly needs to be cheap. So when we get more turbulent markets, even a 60-point or a 70-point could be worthwhile. But it also has to do with where you position it, Andrew. I think if you position them in the traditional 20, 30 points below the money, the width matters more. But if I'm positioning a little bit out of the money, the width is still going to matter, but I can be a little bit narrower. I just felt like by looking at this analysis here that if you look at the price of these butterflies, for example, they range from like $5 to 75 cents, and these are 30 wides at this point. So let me just show you a couple of these.
So it's not just the environment or the volatility that drives your decision. It's also what you think is quote unquote best value for width.
Yeah, I'm looking for value as well. So
because I was going to say, it seemed like your conclusion would be the higher the volatility, the wider the structure, but that's not. That's just part of your analysis.
Yeah, that's part of it. I don't think there's one perfect answer, which bugs me. I think it's like all this stuff. It's a trade-off, and you kind of have to make a choice.
Yeah.
Wouldn't that be easy? But I mean, if I feel like it's a really good deal if, like these 40 point butterflies at this point, they're $4. And anything less than $4, they can be worth 4,000, which is like 1/10 of. So you're paying like 1/10 to get in them. Whereas if you look at the 50 point butterflies, you've got to go way out of the money to get down to $5 to pay one for $5. So I just think the 40. It depends on how many days to expiration and so forth, but and this was like 45 days or something like that to expiration is this data. I just think that's a better bang for the buck, because at the end of the day, you've got to sell it, and you want to sell it for more than you want. And when you look at this, what I did here was I stressed it, the butterfly up 30 points and down 30 points, and then slid up and down the butterfly pricing to see where the better values were. And if you look at these 40 point butterflies at the money here, and you stress them, like this one for example, this 970 at the time was right at the money. If we go up or we go down, it's bad news if you're at the money, because it's about worth about as much as it can be. So that just brings further credence to the idea of, if you got the marble on top of the world, you might think about peeling some of these off. I know Ron has a lot to share, so I will stop at this point and let him cover, because I know there's a lot of space travel to cover here.
Hey, I appreciate it. That was great analysis, and definitely got the
you're giving us a lot to think about.
Yeah.
Oh, you're very welcome. You're very welcome.
Ron, did you need to share your screen again?
If people want to see the spaceship stuff, sure, I can share some stuff here.
We do.
Okay, great.
We'd love to see it.
Yeah, thanks again, Chuck. It was great.
Oh, thanks, Tom.
All right, so if you want, I can quickly show all of them, right? So this is the crappy one. So this basically has no upside risk, and my expectation is this thing is just going to expire worthless now. But you can see that there's no risk to the upside. This was a very short term. I think at the time that I put it on, it was only like a month out. So I knew that it wouldn't do well, but I just wanted to test it, just kind of be sure, right? And I think it is tricky to do these kinds of structures when, it's just out 30 days, right? But even still, you can see that you can kind of get this thing through to break even if it doesn't go your way, so that's fine. Then the March one currently looks like this. This was adjusted yesterday. So what happened was that this position had, if I kind of undo, it kind of looked like that, right? So you can see that the price had kind of, wandered in through to the structure. So at this point, what I'm looking to do is to basically peel off the front and the back to basically lock in some profits and, bump up my upside expiration line and flatten out a little bit. So when I did that, it does that, right? So my expectation from a market perspective, without getting into too much stuff, is that in all likelihood, I'm still overall bearish, but, since we were here, which was, pretty close to this prior low, I'm thinking, okay, we may get a little bit of a retracement before we get the next leg down. So I was happy to be flat instead of having a lot of negative deltas, but you can see here that, slightly negative. But even if it comes down through to 1800-ish and then bounces up a little bit, my expectation is that it's probably going to take a couple of days before the next leg down. By that time, my negative deltas will have built up, right? So if I go forward, I don't know, even let's say a week and a bit, right? So by next week, it'll look like that, and if price is up here and then starts coming down, then I'm good, right? So that, and also notice that I'm with that adjustment of the peel when the price got in through to my structure. Remember that I had kind of like debit spreads here, right? But by peeling that thing off, I'm basically locking in some of those profits. And my upside expiration line now is at, if you look down here, is at basically $1,000. And the key of what I was going at before is that, yes, it's $1,000. It's not perhaps a huge amount, but my PM is 4K, right? So we're looking at a 25% return on PM. So that's the March. The April looks like that at the moment. So again, hasn't come into my core structure yet. I've still got minus 3.6 delta, so it's perfectly fine. I'm happy if it goes down to 1800, no worries. But if it gets through to around here, I would probably normally consider peeling off, which I may. As a matter of fact, yesterday I kind of took off one of these put debit spreads. So yesterday I kind of looked like that. And I thought I wanted to lock in some profits and lift this line. So I basically closed out one of my 4 put debit spreads from here. And you can see my upside expiration line is now at break even, right? Minus 15. So I don't care what it does on the upside. Again, I'm expecting some kind of, even if we retest 1800, some kind of retracement up a little bit. And then probably next week, then the next leg down, right? And again, by that time, I'll have more negative deltas in this particular trade. So that one's looking good. And same thing again, right? I mean, even though it's not locked in, it's currently at a profit there of about 1400-ish. You can see here, right? Out of a margin of 4K, right? So again, we're looking at about a 25% return on PM there. Then my May one is pretty fresh, brand new. That's why it doesn't have a profit hump yet. All right, but the May expiration became available, I think, a week or so ago. So I just layered up one on there, and I was happy to be flat because, again, my expectation is that we may find some level of support at around 1800. So I was happy to be flat instead of, say, minus 3, 4, 5 delta or whatever. My June looks like that. So still minus 3 deltas. My upside expiration line is at minus 400. But again, this is a June position, right? So I've got plenty of time to bump this guy up. Now let me kind of show the full trade. All right, that's what it looks like. So, and again, if we get a bit of movement and then this thing comes back down, I've got a really nice big wide profit hump just waiting for it. Okay, so that looks good. And again, it's up over $1,000 out of 4.7K. September. Let me kind of move that a little bit. Looks like that. So again, huge profit range potential. Upside expiration break even is minus 390. Looks fine. It's up a couple hundred. It just needs to build that profit tent, but it looks fine. And then,
Ron, have you done any analysis on whether certain options are generating the profits in these far out trades?
Yeah, well, what you'll find is that the further out of the money you go, the more they actually decay, right?
Right. But in other words, is it the further out of the money options, the spreads that are way down below that are generating the profit more than the ones that are closer? Have you looked at that at all?
Yeah. That's the entire concept of the trade, right? So actually, if I just stick with this one. All right, so this is the ratio variation, right? Not the condor, right? So this is naked over here, right? And even though this thing over here says it's at a loss, it's actually not. So if I switch through to real P&L, because I found that with a ratio, it kind of does that. It drops the T+0 line much more than it does with the standard condor. So you can see here it's actually up a little bit, okay? Again, just needs to build up that profit hump. But and you can see that expiration line there, sorry, the T+0 looks slightly above 0. But then when you switch a ratio variant to Vol Smile, which is what I recommend everybody uses, you can see that it drops that line down. Okay, but it doesn't matter because what does matter is the Greeks that you're looking at, right? Not P&L. Right? P&L is irrelevant when you're looking at toss false mile. Okay, so that looks perfectly fine. I have a completely flat line all the way down to here as I would normally expect. Okay, but to answer your question, Andrew, the whole point of this trade is that yes, this guy over here, which is further away from the money than this guy over here, because this is just long put and this is a short put, this one over here is going to decay more quickly than this one here. So since it loses its value, this one here becomes stronger, and that's the whole reason why you get the movement that looks like that, right? This is why that T plus 0 pumps up, because this guy becomes stronger as this guy becomes weaker.
Right. This is a simple structure. I was referring more to some of the other ones that are more complicated, where you have, a bunch of different options on.
Yep. It's exactly the same thing, because remember, it's just layering, right? So if I go to something like, I think June is where I've got most layers, right? So you can see here I've got 1, 2, 3, 4 layers. Okay, and same thing here, 1, 2, 3, and 4, right? But the whole premise of the trade is exactly the same. So these guys over here, these spreads, are going to decay more quickly than these spreads over here act as protection. And exactly the same thing happens. So as time goes by, these things, the front ones become stronger because the back ones become weaker. And that's what lifts your T plus 0 up. Right? And as that decay happens, and these things get weaker, and this thing starts to bump up, that's where you can basically say, all right, fine, can I lock in profits or roll some shorts up or add a new layer or do something such that basically I'm happy to flatten out my T plus 0 a little bit, but increase my upside expiration line to something higher than what it is now to lock in profits on the upside. All right, still keeping a very safe looking graph. Does that make sense?
Yeah. So, what you're seeing in the real world confirms, what we've seen as far as the difference between decay of at the money and far out of the money options.
Well, yes, although that's not something that's commonly taught, right? People don't typically teach the fact that out of the money options decay more quickly than closer to the money options, right? People just focus on the expiration, right? They'll basically say that something that's further out in time is going to decay slower than something that's closer in time, which is true, but nobody really gets into the fact that, again, out of the money in the same expiration will decay faster than closer to the money stuff, right? And again, you can maintain a bias, as you've seen, like with this trade here, right? You can have a bias. You basically say, okay, I'm expecting a bounce, I'm happy to be flat. If I'm expecting to be bearish, I can add another layer that gives me some more negative deltas. And at the same time, we'll bump up my theta. Right? And this is what I'm saying that I've been doing, right? So that I'm basically playing little bias movements, if you like. So if I'm right now, as I've mentioned, I'm expecting probably some level of support and a little bit of a bounce, so I'm happy to be flat. But then when we do bounce and we're somewhere up here, and I see some kind of signal, let's say that we're here and we kind of bounce up through to somewhere around here, and I'm seeing my stochastics, over here and overboard, maybe with my longer term thing, and what have you. Basically, I start seeing some signals this thing is starting to roll over. Then at that point, I'll probably add another layer with some negative deltas to help this thing come down more profitably into my structure. Right? So you can still play around with this thing and make it a little bit more interesting, right? And make some money out of it, more than just put it on, slap it on, think of it as a hedge, and just forget about it, right? You can do both. You can do that if you want, but you can also tweak these trades to add a little bit of bias as you go.
I guess your imagination is the only limit on what you could do.
Yeah. All right, but the core concept here is still the same. You still have your debit spreads over here, and you got your credit spreads behind them. All right, I'm just adding layers on top. So my, this is March, yep. All right, so here's that debit spread. I've got more debit spreads, and then you start going to the back, and you start seeing your credit spreads back there. All right, back here as well. So the same concept. I'm expecting these guys to decay more quickly than my front ones, and that's what makes money. right? And on move down, I don't freak out anymore. Now, market moves down, I'm like, hey, great, you know. Before I used to freak out. Well, not freak out, but you know what I mean. I got to travel, it's no problem, you know, don't worry about it.
Did you see a couple questions in the chat?
Okay, no, I didn't see them. As a P&L in Smile, yeah, basically everything I showed was in Smile. But what I do is that in the Skype chat group, the index income trading, I'll typically post, I mean, these days I don't necessarily do it on a daily basis because it'll be boring for me to post charts that look so similar, but at a minimum on a weekly basis, I post what all the live trades look like using Smile, but then I also put in the real P&L for each of the trades. Okay, so I do that pretty regularly in the chat. For the ones that have locked-in profit, well, this one here has locked-in profit to the upside, if you want to think about it that way, right? So they're saying, what percentage is that at? Well, remember, the whole point of this trade was to try and develop something for portfolio margin, right? So it's basically at somewhere, I mean, let's see what the real one is, right? So if I flip that. Okay, so real P&L is around $1,300 out of $4,000 PM. Right? Right. So somewhere around whatever that comes to, 25-ish.
It's a fantastic return.
Yeah. Right? And these things, I mean, I'm still keeping them, you know, relatively smallish because I want to make sure that the Greeks work exactly how I expect them to work and all that kind of stuff. But everything's playing out. So I'm going to start scaling these puppies up pretty soon. Right, and remember that from even though this thing here says it's, you know, $4,000 of PM, if you remember my presentation, if you then look at the overall PM for all of the positions combined, for some weird reason, then it ends up being half of that. Right, probably because they're all in the same underlying blah blah blah. I don't know what their rules are, right? But it's what it comes down to in reality is that this is basically a $1,300 profit out of probably about 2.2-ish K. For PM. All right, so 50% return on PM, which is great, with a ridiculously safe trade.
A couple more questions.
Okay, all right. Typical question that I get a lot, right? So will the PM margin remain the same? No, it will not. Okay, so what will typically happen is this over here is the 12% down slice. You can see here that it's basically at about $2,000 down, right? So in theory, if you were just look at that, this over here for the PM should be 2,000. The thing is that in order to calculate your total PM, they also look at the total amount of contracts that you have, okay? And they do whatever fancy formula to basically come up through to $4,000. So in short, if this position were to move down through to here, then my 12% slice may go down to here. So I may go from -2 to, you know, -5, let's say. And if, or, you know, maybe a bit more, say -6, okay? So if it does do that, then this thing over here is most likely going to say $6,000 PM margin, right? Now, so it will increase. Now, here's something important though, right? So people kind of relate increase in PM margin as being really, really bad, right? Or risky. And it's understandable because if you come from a background of trading naked puts, it should freak the crap out of you, right? Because if you've got a naked put and the market goes against you, both from a price perspective, but in particular from a volatility perspective, right? That position may still be so-called safe from an expiration line perspective, but your T+0 is going to look pretty awful. It will have drawn down, and if the vol has spiked significantly, it will have drawn down significantly too, right? So what can happen now is the risk you run is that now the broker says, okay, you know, you've run out of available cash in your account, you don't have sufficient margin, so you get that margin call, and they tell you you either bring money into the account tomorrow or we're shutting your position down, right? Why is that bad? Well, it's bad because IV is up now. In 2 days, that IV might crush, and your position looks perfectly fine in 2 days. But if your broker gives you that margin call and forces you to shut down your position, they force you to take that loss today, even though tomorrow it's going to look great, right? That's the risk. Now, do we have that risk here? So let's say that for whatever reason, let's say that price comes down through to here, right? This is, what is that? Let's call it another 100-point drop, right? Just to kind of round it out. And you might say, well, my margin is going to go from this level down through to this level. Now let's pretend that I had such little cash in my account that this forced a margin call, right? So what's going to happen is that right here I'm up, let's call it $1,300. If I move to here, I'll be up, let's call it $1,000. So the worst that can happen with that 100-point drop, when I get that margin call, is if they force me to shut down my position, they force me to take $1,000 profit. Boo-hoo. Right? It's a totally different situation, right? Because the position will typically be in profit when you get that margin call, if you ever get that margin call. Right? Hopefully it makes sense. The other question here is how to defend the position when the market is moving down. Well, I spent almost 2 hours covering everything about this particular trade, so I'd recommend that you just watch that. But there's multiple ways to adjust on the way down. Okay, as a matter of fact, what I would... I'm pasting the YouTube link there. If you guys don't mind, if you could go in there and just, if you've enjoyed the presentation, just click on the thumbs up there. I've got a couple of trollers that go around disliking everything I do, so I want to drown those guys out. But that's where you'll find the presentation. And again, I go through to everything in lots of detail there, both how to adjust on the downside, how to adjust on the upside, how to do price layering, time layering, a whole bunch of stuff. Okay, it's all in there. The last thing is that on my charts, is that me? No, okay. That's someone clicking the video. On my charts, you see that I've got these labels up here, right? It has a whole bunch of what I think is useful info, right? IV rank, percentages, standard deviations, monthly, daily, weekly, ATRs, a whole bunch of stuff, right? I've had a lot of emails from people saying, you know, where is that? Well, this is custom code that I wrote. And to save myself from answering these emails constantly, I am posting that link in the chat right now. And for those of you that are members, gold members of Capital Discussions and have access, therefore, through to the member forums, you'll have access to the code for all this. Okay. The only thing that I'd request is that you don't post that out publicly. All right. So I'm happy to share it across people that are gold members, just to help out Tom. And Capital Discussions, but please don't share them out, and then you'll get all of this stuff that you can add to your charts. Okay? That's all the questions that I see listed. Any other questions about the space trip or anything? Nope.
Covered it all pretty well.
Cool.
And as it turns out, looks like we're at a good place to stop. We're right at an hour. Don't like to keep people more than that if we can avoid it. So another great meeting, everyone. Thanks, Chuck, for the great spreadsheet preview. That was really nice. And Ron, nice detailed overview of the space trip trade and good discussion about the downside adjustment. So again, really good meeting, everyone. Thanks for attending.
All right, guys. See ya.
Well, we'll see you next week, and tomorrow Jim's going to be on and talk about the Kevlar, and then next week Tim Pearson's going to be on the round table. So looking forward to that. So we'll see you in the other meetings, and if not, the next week's meeting. Thanks, everyone.